You're watching our continuous coverage here from the World Economic Forum in Davos. Joining me now is Abid Neemuchwala of Wipro. Thanks very much for our annual conversation that we have here, Abid. The mood here is one of caution, of pessimism. But one thing seems certain, that the tech disruption and the tech transformation journey will continue, which means that while it might be flattish growth, it will be growth nevertheless for companies like yours.
First of all, great to talk to you again. As you said, I always love to have this conversation annually, Shereen. And I think, yes, the people are watchful. And I would not say pessimism, I would still say optimism. But you rightly said, the technology transformation, the digital transformation is here to stay. And now we have moved to talking about the next level of stuff, which is around trust, around transparency, around a policy framework on data, around principles and guidelines on artificial intelligence, which in some sense confirms your point that the technology transformation is here to stay.
Well, let's talk about growth, Abid. And we've had this conversation in the past, and you've been hoping to get to industry-leading growth, or at least industry growth in general. But what seems to be the issue? Because we still haven't been able to see that happen for you.
So again, you're talking Wipro specific, and I think, we've been executing on our transformation, the strategy that we've articulated. And when you compare industry matching or industry leading growth, it typically is compared on a year-on-year figure. I would start with quarter-on-quarter first before I go to year-on-year, because there is a build-up that happens. But personally, I feel quite good in how we have progressed, how we are winning deals, how we are executing for our customers, how we are able to hire talent and execute on each one of the strategies. For example, 33% of Wipro's business now is digital. We have been recognized as a top 5 digital brand across the IT services industry by IT SMA. We've done very well on cloud. Cloud business is now over $1 billion. The investments that we've made in localization has paid us quite well, where in the US we are over 60% local. In most of the other markets, we are about 2/3 local that we deliver. So access to talent, our ability to hire, our ability to build cadre has been good, which helps us fulfill customer requirements quite well. Our customer satisfaction is at an all-time high. Having said all of this positive stuff, we still have some areas that we are working on. One of them is our India business, which we restructured last quarter. Perhaps could we have done it a few quarters back? Answer is yes, but then you have to pick one item at a time as you are undergoing a transformation and prioritize. The HPS business, which is our healthcare business, which serves the Affordable Care Act, is still in a, not bottomed out yet, but still in a downward spiral, simply because of the political environment that is there around the ACA in the US. And a couple of verticals have kind of come back, but they'll take time to completely get to a industry matching curve. And that is just work in progress.
So do you believe that you have now the levers and the pieces in place to be able to break out of this 5 to 6% kind of growth range? And on the margins as well. I mean, you've gone from about 21 down to 17 now. Is this the new normal?
So let me answer the margins question first. When I took over, we said that we will invest in the business. We did some acquisitions, we did some investments, we ran the Horizon program, which is the entrepreneurship program to build certain practices. And I think we did very well on those investments, because now we have all the capabilities to win in the market. That took our margins down, because in any such transformation, you have to make the investments. You can't compromise the long term for short term margins. I think now we are, again, if you look at the last 4 or 5 quarters, we've been on an upward trajectory on margins, and in quarter 3 our margins were 19.8%. So I think we will stay in a narrow band, but I don't think the margins will be as low as you mentioned. Also on the growth, similarly, I feel quite good that we are now ready to capture growth. We have the right capabilities, we have the right customers, we've got the right balance sheet. I also focus a lot on the quality of revenue, not just growth. So it's profitable revenue. If you look at some of our metrics on the balance sheet, they have improved quite significantly. So I feel quite good about it overall.
Okay. You talked about the challenges that continue on the healthcare side of the business, and you believe that that hasn't bottomed out just yet. Which of the other verticals where you feel that, they will be the engines of growth, so to speak, and you'll be able to continue to see the kind of momentum, especially on the BFSI side, if you can see that being replicated as well, and the other pain points that you hope will be addressed as well?
So this quarter, if you look at Q3, three of our verticals, BFSI, consumer, and energy and utilities, grew double digit on a year-on-year basis. So I think I feel quite good about it. A couple of verticals, I think comms has been growing, but it'll be a little couple of volatile quarters here or there because of the industry. But with 5G, I'm very upbeat about the comms vertical in the medium term. Manufacturing will take a little more time. Health, core business of health is very good, but till we bottom out on HPS, it'll see some volatility. Just as an example, this year, the open enrollment period is around the November-December timeframe. And we have 10% lower open enrollment compared to last year, which essentially means that it will have an impact on next year's revenue because this is a platform-based business on a per-member pricing that we have.
In terms of costs, and I was asking this question of your peers and colleagues in the industry as well, are you seeing a structural change as far as costs are concerned? Are we now looking at higher costs, whether it's on account of visa regulations, whether it's on account of localization? Are we looking at a structural change as far as the cost structure is concerned?
So, Shereen, there are both sides. There is a structural increase in cost. For example, when you localize, as I said, if I have 60% people in the US local, historically in our industry, if somebody gets off a project because the person is on an immigrant visa or non-immigrant visa, the person is shipped back to base location, which most likely happens to be in India. In the new normal, you carry the bench in the US itself because it's a local hire. So from that perspective, your answer is right that the cost will be a little higher. Also, when we do agile DevOps, especially when customers do it for the first time, they want more people to be on-site, and structurally the on-site margins are lower than the offshore margins. So if I look at some of these parameters, yes, the costs are going to go up. But on the other hand, if I look at technology, artificial intelligence, robotics, automation, this quarter we almost automated 6% plus of all of our fixed price run business. So 6% of the effort was delivered by automation. Similarly, I'm very proud of our crowdsourcing investments. Topcoder, which is not only one of the world's largest crowdsourcing platform, but internally we've been able to deliver development projects through crowdsourcing, which creates a new cost point and a price point for us to be able to deliver service. So I think if you balance the two, in the long run, efficiency will be as important as growth and transformation.
Okay, going back to growth now, and if I were to look at the numbers, about 250 basis points has really come in from the acquisitions that you've made. What is it that you now hope to do as far as the acquisition strategy is concerned? Any specific capabilities, any specific areas that you would like to beef up by way of the inorganic route?
So every year we do a rolling 3-year strategy plan, and we create white spaces in our strategy, which essentially means things that we want to strategically do, but at the same time either we don't have in-house capabilities, and either we build it in-house or we buy it. So those white spaces we always keep looking for potential acquisitions. Now, there are two things around acquisitions. One is you should find something that matches that white space, and then you have to find it at a price that you can pay.
Have you found both?
So whenever I find both, you see an announcement in the newspaper that we acquire. We continuously keep looking. We literally look at 4 or 5 potential candidates every month.
Every month?
Yeah. But if you look at last year or last year and a half, I think the market was quite overheated, and the asset prices go up when the market is overheated. So normally you don't meet the price criteria, even if you meet the asset criteria. I think also we did a fair share of acquisitions in the right places. We did Design It, Cooper, and the Australian design acquisition that we did, which created a good critical mass for us for our design and interactive business. The PRO acquisition has worked out very well on the cloud applications and Salesforce business, and so on and so forth. So I think we've got a good deal of acquisitions that we did, which helped us take the capability to the next level. I'm not in an urgency to do another acquisition right now, but if you find a good deal at the right price, we will do it.
I just want to focus a little bit on the digital side of the business, because that's something that you focused on and talked about as well. In terms of the kind of deals that you're seeing, sizes, what is the outlook for 2019, given the fact that this now no longer is a discretionary item as far as the CIO is concerned?
So, the good news even here at Davos is, even where people are watchful, even where people are getting prepared for a macroeconomic headwind, the spend on digital and continued digital transformation is taken as a given. Digital is happening at scale. Earlier, 2 years back, people were doing proof of concepts and pilots. Now they're saying, how can I completely transform my organization digitally? And as you know, we have won our fair share of deals where we are the digital transformation partners for our customers. So I think digital is here to stay, and we've got a good place where about 33% of our revenues now are digital, and they are growing.
What's the target?
100%.
Realistically.
Yeah. I can't imagine going to a new customer and saying that I'm going to do legacy work for you. So all the new work that is coming is digital. What happens is the legacy work retires over time. And then the same people who are doing that work, who have deep knowledge, get reskilled and start doing digital work. So it's an ongoing transformation. I don't think anybody is adding incremental legacy work. Everything which comes in is for digital transformation. But just, the technology debt, as we call it, takes time to get retired because there is assets on the balance sheet of our customers, which will take time till they run out. So that is, in the next 2 or 3 years, I do believe that over 90% or close to 100% will be digital.